While the spring real estate market appears to be cooling, getting the right mortgage could still be a little bit daunting. Some lenders are offering relatively lower rate. Experts are asking if there's a catch. Joining us now to break it down is Peter Sashecki from Everything Financial. Good morning, Peter. We're going to talk about these low rates that some are offering in a second, but I want to ask you about this Fidelity report. First of all, they were talking about earlier how Canadians feel like they need $1 million to retire. This is what people are feeling right now.
Yeah.
Do they need $1 million to retire?
Some might need more, some might need considerably less. And we've talked about this in other segments in the past few years. To put an arbitrary number on it is really irresponsible, and it's really there, it's employed to make people buy more investments, make people invest more money that they may not need to. So you really, the first thing you need to figure out is what's your cash flow? How much do you need a month? Then you work backwards. How much do I have in old age security, CPP, pension from my company? What's left over? What's the shortfall? And then you just figure out what lump sum of money times 5 or 6%, so the interest, will make up the shortfall. So quick to do in 30 seconds, but the $1.2 million number is kind of irresponsible and may not be right for you. Yeah. There's a lot more to it than that.
Yeah, that's what Canadians believe right now. Yeah. So they're believing $1 million, but they may not need that. Okay, let's talk more about this interest rate that's kind of out there. So people are wondering if they're, if a mortgage rate is good or not. How do you determine, hey, this is a good rate? What's a good rate?
Yeah, well, a good rate right now would be in the high 3s or low 4s is rate. But when you see these ads out there, like the one right there right now, 1.99%, immediately when I saw it, it's like, what's the catch?
1.9. We haven't seen interest rates that low in years.
And we might not see interest rates that low for many more years.
Right.
So how is someone
there is a catch.
There is a catch. It's a 6-month introductory rate, but then they convert you. The company then has to convert you to a 5-year rate. Well, right now, we don't even know, because they don't post it, if their 5-year rate is even competitive. And if you leave them, we do know this, if you leave them after that 6-month introductory rate, there's a lot of fees that are involved if you leave them. But that's not even the big question. The big question is, can you leave them?
So it might be something in the contract.
Well, they're approving you with the stress test based on the lowest rate, which is like 5.25. But if you go there and the new rate, say, is 5, the stress test is going to be 7%. So you got approved for one rate, and then when the 6 months comes up, if you say, hey, I'm willing to pay the fees, I want to leave, you might have been approved for so much that you don't qualify to move elsewhere. Now you're stuck with possibly a highly inflated rate versus some of the competitors, and you can't move. So they call it the old bait and switch. And they bait you, they get you in, then they switch the contract. So buyer beware.
Yeah, and a lot of people, we know that this year is a big year when it comes to mortgage renewals. Maybe they have had to renew, or they will be later this year. So what should people be doing when looking for a mortgage rate, whether it's renewal or maybe finding a new one altogether?
See if it's competitive. See what the fees are to get out of the mortgage if you have to. But try and look at 2026. Try and push it down the road to mid-2026, because a lot of economists feel, just based on everything going on and with our poor economy and everything else, poor real estate, like you name it, not to be so negative, but that might be the time when the rates hit their lowest point, is about another year from now. So if you can push renewals with shorter term down the road a bit.
Like a year, you can get a year.
A year down the road, and people go, yeah, but the 1 year is 6 and the other one is 4.25, the 3-year. Yeah, but if you look at that 1 year, your actual cost difference of money is very minuscule. Don't get caught up in just the number.
But over the long term, if they get something longer, they may be paying more.
Yeah, because you get locked in for a higher rate, and then you can't take advantage of those low rates when they hit. Hopefully next summer, at least that's what a lot of economists are thinking.
Okay, we'll push it for a year then. Peter Sashecki, Everything Financial. Thanks for your insight this morning.
Thanks, Carrie.